In the previous classes, friend, we have discussed the concept of cash flows in the business. We have also discussed the shortcomings or limitations of calculating cash flows from profit and loss account. Then we have discussed then what should we, which financial statement reflects the true cash flows in the business. So the answer is cash flow statement. Cash flow statement, I think, is the most reliable type of financial statement which truly reflects the cash generation and cash payments of the business during a particular year under assessment. Although there are some drawbacks and limitations of cash flow statement as well, which will be covered in class number 66, but still we can say this is the most reliable type of financial statement. So it rectifies to a greater extent the limitations of cash profit calculations that we have discussed in the previous videos. Now, what does cash flow statement represents to us? The the basic theme of cash flow statement is very simple. You take the opening balance of cash and bank balance as on 31st March of your previous year. So how during the year, how much cash you generated, how much cash you dispensed or paid, cash or bank, right, during the year, right? And after adjusting this, after deducting the payments and adding back the generation, your net balance should match with the closing balance of your financial year, closing balance of cash and bank of your financial year, right? So this figure of cash and bank opening and closing, you can easily get that from the balance sheets itself. So the question only or the calculations are only done for with respect to generations and payments during the year. How much cash is generated, from which source it was generated, how much cash or bank is paid, and for which activity it is paid for, right? So this actual movement is basically traced in the cash flow statement. Now I have said to you that how much cash is generated and from which type of activity it is generated. Whether we have generated the cash by taking the bank loan. When we take the bank loan, we get the cash, right? Cash or bank, one and the same thing. Whether I have generated the cash by selling my fixed assets, by selling off my machineries, by selling off my land and building, right? Whether I have generated cash by receiving the interest, whether I have generated cash from sales of my goods and services, right? So there are multiple type of activities in the business that helps in generation of cash during the year, right? So in order to classify this generation and payment activities, cash flow statements classify them into three parts. The first part is the operating activities of the business. Second part is the investing activities of the business. And the third part is the financing activities of the business. So you calculate your cash generated or cash paid in your financing activities, investing activities, and operating activities. So what are the examples of financing activities? For example, you have issued new shares, raised new share capital, you received the cash, right? So this is a positive sign. You have received the cash. Positive signs in the sense that the cash has come in into your business. You have taken loan from bank, the cash has come in, so your cash balance will improve. Plus sign represents your cash and bank balance will improve. Unsecured loans, you have taken some unsecured loans, your cash and bank balance will improve. You have made interest payments, so interest payment is your financing activity, your bank balance will reduce. You have paid off the loan, you have paid off the principal amount, your cash and bank balance will reduce. You have withdrawn the capital for personal use, your bank balance will reduce. You have paid dividend to your shareholders, then your cash and bank balance will reduce. You have bought back the shares, you have done buyback of shares, your cash and bank balance will reduce. So the net effect of this activity will result in cash inflows or used. NCF means net cash flows, and U means net cash flows or net cash used in financing activities. That is the full form of this, right? So if the balance is positive, that means you have received net cash from your financing activities. So there is a net cash inflow. If there is a negative balance of these activities, then that means you have used the cash in here more. So the balance would be negative. You have used more cash in your financing activities. So right, so this is your financing activities example. Now coming to the investing activities. So if you have purchased any assets, securities, or investments, right, and you have paid them from your bank account, right? So this will appear as the negative balance because your bank balance has reduced. If you have sold off assets, investments, securities, you must have received bank balance. So your bank balance will improve. So this is a positive. Your bank balance ultimately gets improved. So on your investments, you are receiving dividends, you are receiving interest. So this will improve your bank balance. So this is represented as a positive figure in here. So the net result of this will show your cash inflows or usage in investing activities. So friends, investing activities and financing activities, calculation method of investing and financing are very direct methods. There is no dual method of calculation. You simply take the issuance of share, debt repayments, interest repayments, purchase, sale, etc. You pick up the entries directly as they have happened, and you take only the actual payments, right? If you have sold off the assets but you haven't received the payments yet, so this will not then appear in here. So you only show what you have actually received or actually paid during the year in this statement. So the method of calculation is very simple. But when we come to the operating activities, this is the core operations of your business. When you come to calculation of operating activities, so the calculation methods are two. One is called the direct method, like them, and one is called the indirect method, which is the most famous method of calculation, which will be covered in the next video itself. So direct method is very simple. This is top to bottom approach. You start from sales. So you take actual cash that you have received from sale of your goods, services, and other direct incomes. For example, if you, in your profit and loss account, if you have seen any dividend income or your interest income, then you will not show that interest or dividend income in this head, because interest and dividend income that you have received is part of your investing activities. So you will show it here only. So only those income which are related to your core business operations. For example, you have done any exports and you have received your export incentives, duty drawbacks, then these are not investing or financing activities. So what I mean to say, that you need to clearly have a broad picture in mind about what incomes and what expenses, what items are basically related to investing and financing activities and what are related to operating activities. First, you need to classify them in investing and financing activities. If you are able to put them in a specific head or investing or financing activities, then you need to ignore them out totally in calculation of operating activities cash flows, right? So other incomes which are directly related to operating nature only, which are not, basically I want to say, which are not part of investing or financing activities, that income should be taken up here. Minus your actual cash paid for. I am talking about only actual cash paid for, not any accrual concept. Actual cash paid for your purchases, your direct and indirect expenses that you have paid for in actual, right, should be deducted from here. Then you deduct your taxes paid during the year, and then the net figure represent your cash flows from your operations or your cash used in the operations. So these are the three heads basically. So I will repeat it again. Opening balance and closing balance of cash and bank you will take easily from your balance sheet. It was the only question about the generation and payments during the particular year, and these generations and payments have been divided into three activities, three parts: the generations and payments from operating activities, the generation and payments from investing activities, the generations and payments from financing activities, right? I hope you have understood the concept of cash flow statement. In the next video, we will discuss the indirect method. Thank you very much.